In this module, we will review how private equity funds position themselves in their market, how they develop a pipeline of potential investments, and how they determine whether a specific opportunity is worth pursuing. Positioning means that the fund's investment strategy needs to be the right one for them and the market they are in. Developing a pipeline means that the fund's method of sourcing or origination should result in a steady flow of good opportunities. Determining if something is worth pursuing means the fund needs to have a good technique for a disciplined screening of investments to decide whether to proceed to the stage of serious negotiations and signing of a term sheet, which is a big step because it carries financial and reputational costs if things fail at this stage. Every fund's investment strategy will be located within a wider investment theme. There are only a certain number of private equity investment themes which can be thought of as underlying investment patterns. Themes include consumer-driven industries such as retail, healthcare, FMCG, education. A second theme is the knowledge economy where innovation is concentrated, such as software or fintech. A third theme is regional consolidation, where companies grow through acquiring competitors and developing a regional mindset. A fourth theme is financial intermediation, investing in banks and non-bank financial institutions. A fifth theme is infrastructure and energy, where private equity funds may invest in the innovative end of this area, such as clean energy or battery storage. Most funds' specific investment strategies shall be located within one of these themes in order for them to have sufficient focus. We can take the example of a Middle Eastern mid-cap fund that invests mainly in health, care and education. So they operate within the consumer industry theme with a defensive strategy based upon the premise that in a downturn people will cut down on buying goods and going on holiday, but never on their children's education or their healthcare. Another example is a European fund that invests in battery technology and power plant control software, thus pursuing a niche innovation strategy within the energy investment theme. A successful strategy will depend on two complementary factors. The first being that the market segment should be attractive, and the second, that the experience, skills of the private equity team should be relevant to the segment chosen. Having established the investment strategy, we need to consider how the investment team can generate a suitable pipeline of potential investments. Because of the selectivity of private equity investment, it is important to have a wide range of opportunities. Private equity funds might invest in only 1 to 2% of the companies they look at. A study by Invest Europe showed that European private equity funds had invested in 20,000 companies out of 20 million companies in Europe, which is 0.1%. So how do we generate this pipeline of investment opportunities? There are 5 ways for a fund to do this. Let's look at each one in turn. The first way is the so-called cold call, that is, receiving an unsolicited approach by someone unknown, by phone or by email. Funds will receive many such approaches, so the volume of potential opportunities is high. The downside is not knowing if these are serious or not, or if there is proper information available. So managing this channel requires the ability to do a quick sift. The second way is that an intermediary, like an M&A broker, introduces an opportunity. This means that this may be real and that some selectivity has been applied. On the downside, the opportunity may be being shopped around to others, and the quality of information may be poor if the intermediary is second tier. Managing this channel requires having a good network of trusted intermediaries. The third way is that another private equity fund invites our fund to co-invest with them into their deal. This is very attractive because of the fact that someone else is putting money on the table, which makes it serious. The downside is that the lead investor may dictate terms and the way the due diligence is conducted, as well as expecting our fund to return the favour in the future, which creates an obligation. The fourth way is that a member of the private equity management team proactively develops opportunities by doing research and going to visit companies and developing relations with their owners and management. The attraction of this way is that it may lead to a pipeline of proprietary investments, that is, investment opportunities only this fund may see. It is important to note that having a so-called proprietary pipeline is a big selling point fund managers have towards their LPs when fundraising. The downside is that developing this is very labour intensive and can result in many wild goose chases, which lead to nothing concrete except satisfying the curiosity of companies so painstakingly visited. The fifth and last way applies in the case of a fund being part of a larger group, such as, for example, the private equity unit of a bank. In this case, the network of the mother company can be harnessed to generate opportunities. The downside here is that it will be important to manage the relationship with the rest of the group, especially in the case of turning something down, so that it will work for the private equity unit going forwards. This inevitably involves corporate politics management. So now that we have generated investment leads by either cold calls, broker introductions, co-investor invitations, proactive search, or through the mother company, how do we go about assessing them? Let's now turn to the process of screening investments. The outcome of a screening should be a decision to proceed or not with due diligence and the signing of a preliminary agreement with the company and its owners, mostly referred to as the term sheet. It is important to get it right because if a deal falls apart later in this process, it will always reflect badly on the private equity team and will have cost money and other resources. The first thing to do when screening is to look at not just one set of dynamics, but two sets of dynamics. By this I mean the forces driving the interest in private equity investment, not just by the company, but also by the ownership. You need both of these to be aligned in order to have a deal. Just think, if the company is doing well, growing, generating cash, well managed, what does it need the private equity fund for? So there needs to be a problem that private equity can solve. It also needs to be the right kind of problem, rather than the wrong kind of problem, like imminent insolvency. What company problems can private equity solve? Well, these can typically include providing capital for further growth, paying off excessive debts of an otherwise sound business, or replacing a negative owner, like an uninterested mother company. What about ownership problems that private equity can solve? Well, these can include the need for a strong partner to support the next phase of growth, taking some of the burden off the founder's shoulders, or taking over from owners who want to slow down or who have no children to take over the business, or resolving a conflict among different owners by buying one out. As we have seen, before we even get to starting to make an investment, we need to lay a solid groundwork. The fund needs to have an investment strategy that is right for the market and which plays to the team's strengths and skills. The mechanism for generating leads needs to be able to produce a steady stream of the best quality possible. Then the fund needs to have a clear and consistent set of criteria to apply so that only the right opportunities will get a green light to move on to the next, more high-profile stage where so much more is at stake.